Hey guys, welcome to the Passive Investing Made Simple Masterclass. My name is Whitney Elkins-Hutten. I'm the Director of Investor Education here at PassiveInvesting.com, and I'm excited that you've joined me today. We record this show live every Tuesday to help you learn the ins and outs of passive investing. And so if you haven't done so already, make sure you join us at PassiveInvestingWithWhitney.com. There, we have additional educational materials, webinars for beginning passive investors, people that are, making their first investment, as well as seasoned investors. And then you also get a chance to hop on a phone call with me where we can discuss your passive investing goals. And then, of course, you get on the short list for our deals. You get to see all of our open deals here at PassiveInvesting.com. So make sure to check that out, PassiveInvestingWithWhitney.com. Now, today, I don't have a presentation for you guys because we just had a major bill passed last week, actually. James Bohan and I had been going back and forth, trying to bring him on the show to discuss what might be coming down in the new reconciliation bill, otherwise known as the Big Beautiful Bill. And miraculously enough, it got passed in as we were planning the show. So very thankful that we're going to be able to give you some definitive information on what you should be looking for as a passive investor. But before I get ahead of myself and before we start jumping into the content, I know every time that we do a show like this around taxes, a lot of you passive investors have very specific questions related to your specific scenario. I encourage you to ask your questions, try to keep them as general as possible. Be sure to put those questions in the Q&A box or in the chat box, and I will field those when it makes sense as we go through the presentation. Otherwise, we will hang on afterwards and get those all cleaned up for you. Now, I am so excited to be joined by James Bohan, CPA. James, welcome to the show.
Thanks for having me on, Whitney.
Yes, yes. So James came to me as a referral as one of our internal team members who is an investor, a passive investor, just like you, just like me. James is his CPA. So if I know you guys are all the time looking for referrals. Well, guess what? James is here. He's has been in the space, in the real estate space, in the passive real estate space for quite some time. James, why don't you fill in the blanks for me? How did you get into, accountancy, being a CPA, but more importantly, how did you get into the real estate space and working with passive investors?
I like to say that my mom was a CPA and my dad was a real estate developer, and I ended up being both. And so I started my career working for big private equity funds that were managing real estate for pension funds, institutions, and stuff like that. And so I took kind of like my knowledge I learned from the family, like kind of the boots on the ground, blocking and tackling, property management. And with that knowledge, really understanding the asset class, I was able to slot right into this private equity real estate department at a firm called Rothstein Cass, where I started my career.
Awesome. And so how long have you been in the space? Like your whole life, essentially?
My whole life, but yeah, really as a practicing CPA, I got my CPA in 2011.
Awesome. Okay, so you've seen several different administrations, there are different tax policies. Well, let's kick it off. Everybody wants to know, what are the top tax proposals in, the big, beautiful tax cut 2.0 bill that passive investors should be caring about?
I think the biggest one was 100% bonus depreciation. As soon as Trump got elected, everyone thought it was a foregone conclusion that we would get this back. And honestly, I'm actually surprised that we got a bill passed in Congress and the Senate that wasn't just sending more money to Ukraine and Israel, and that they actually did something for the American people with this bill. So it's, fresh off the presses, so to speak. And I worked a lot last night to give you guys an updated presentation on what exactly got passed this time.
Well, I want to well, go ahead and pull up the presentation. But
Sure.
as we kind of go through the material today, I really want to make sure that we connect the dots for, an investor, not just a real estate investor, but somebody who is a passive investor in, say, like real estate or businesses. How does all of this impact them, and what should they be either having on their radar, as well as, maybe having discussions now with their CPA?
Yeah, I've got some notes pulled up here to go over as well too, based on our initial question. So I think kind of one of the coolest things for investors out of this big bill was renewing opportunity zones. You know, those were a big bipartisan um, program that got instituted with Trump's last tax bill. And it was really cool to see that be extended and actually made permanent. So I think opportunity zone funds are a great thing to come out of this bill. And then, like I said, the 100% bonus. And then a few other tax breaks for people throughout should generally help the economy in the short term, which could, you know, lead to more development, lead to more people being able to afford rents, and just an overall more resilient economy.
Well, awesome. Well, let's go through it. I'm going to turn it over to you because you're the expert in this area.
Okay. Yeah, and feel free to stop me if you think we want to direct anything to be a little more towards passive investors. I kind of put everything in this presentation, and we'll jump around a few points to some stuff that might not be relevant, but I tried to order it in a way that makes it digestible for people, and we get the most important information sooner because we have limited time here. So jumping in, kind of what's in this presentation is just like an overview of what's in there. What's in there is, you know, some social program changes, business tax policy changes, individual tax changes, and what that means from an investment implication standpoint. So a little bit of more about me, like who am I and why should you care about what I have to say? Like I said, I've been a CPA since 2011. My first clients were billion-dollar funds. I used to be the CFO of a real estate fund myself. And following the family tradition, I'm a fourth generation real estate developer and have 5 properties up here in northern Idaho. So the first thing about this bill is that it's big, just like its name says. It's almost 1,000 pages. It's definitely a big government approach. You know, it's not a small government type of bill. You know, there's a lot of policy and incentives being dictated by this bill. And I can't believe Trump got it passed within 6 months of being in office here. The cost of this bill is we are going to see about a $3 trillion deficit increase as a part of this whole bill. They automatically raise the debt ceiling by $5 trillion as well. So they don't have to go back and vote to increase the debt ceiling every so often like they have been over the past 5, 10, 15, 20, forever years. And so, you know, this can have some impact to investors because in a global world and global market, the United States is becoming less credit worthy. You know, so this could lead to higher 10-year interest bond rates. And a lot of real estate is priced off those 10-year treasuries when they do a spread above cap rate. So while this doesn't look like, you know, it affects your investing thing, it's not a tax break or a tax incentive or whatever, it does impact the overall economic world of how you invest. And so it's important to talk about how the United States is becoming more of a debtor nation, much like a lot of the European and other countries around the world are. You know, everyone's pretty much in this large debt world. We're just and have been the least worst for a long time. We could be in a place where bills like this are going to put us at maybe more of a disadvantage compared to other countries based on our debt to GDP ratios and things like that. So it's just something to keep an eye on and think about and why I left it in here. Um, how this bill was paid for the cuts. This was the reconciliation bill. So if we're taking tax cuts, we have to do spending cuts as well. And so where this really got hit is Medicaid and SNAP. Um, the biggest things in there are that people need to be working part-time in order to get their entitlement benefits. And so that was the Medicaid slide. This is SNAP. So once again, think about, you know, if you're investing in multifamily, who your renter class is. You know, if you're doing C or D apartments, this could really take money out of people's hands when they are usually getting these Medicare or SNAP benefits, and now they maybe have less discretionary income to pay a higher rent. So while these programs have these social implications, you know, I want to also frame this from an investor's mindset of how this might affect their investments or their developments or what they're doing and what they're investing in. Um, the last of kind of the social policy shifts I saw in there was a lot of green energy subsidies are being taken away, and more legislation was put into place to prioritize fossil fuel development. And, what is the investment implication of this? Well, right now, fossil fuels are still cheaper than green energy. Say what you will about climate change or having a healthy environment or polluting it, the fossil fuels still give you a cheaper cost per kilowatt energy, so to speak. And energy really drives the economy. And so if this happens like the way they proposed it to happen, we could see some decreased energy costs, which could lead to more economic booms as well. I believe that was their intent with this part of the bill. Um, so now let's dig into kind of more the crux and the meat of what we see as CPAs and tax professionals and tax strategists. Um, there was a lot of dialogue going around between different versions of these bills. We had the House bill, the Senate bill. The House bill got passed, the Senate changed it, and then the House passed what the Senate did. And so along the way, there was a lot of talk about what might happen. And so initially, there was an idea that Section 31 exchanges might go away. Well, they didn't. This happens every time as well with carried interest. Carried interest was talked about being taken away, its preferential tax treatment, and being treated more as ordinary income. I see this happen in every tax bill, is where they kind of put this in, I believe, as like a negotiating point, and it eventually gets taken out before the bill gets passed. Income tax and capital gains rates stayed the same. So there's a lot of small changes in the bill, but like kind of the baseline stuff is still there. And it also preserves the 20% pass-through deduction, which is important for passive investors because it starts to make like your partnership or S corp investments start to compete at parity when people are paying a lower 21% corporate tax rate. So these things did not change. One small note on the pass-through deduction is we did get a slight increase to the threshold for what's called special service SSTBs, which we won't get into today for brevity's sake. So the biggest thing for you all is bonus depreciation. It is back. It's permanent. There are no phase outs for this. This means when you buy equipment, so to speak, you can write 100% off of it in the year you place it in service. Now, with real estate, investors often love this because when they buy a residential building, so to speak, part of what they buy are components that can be classified for assets that can be subject to bonus depreciation. A residential building, not the land, is subject to depreciating its cost over 27 and a half years. But what a lot of sophisticated operators, fund managers, and investors like to see is when you buy something like this, you'll hire and commission a study called a cost segregation report. And with this report, they segregate the cost of the building out between their specialty trades or land improvements or different components, because all these different segregated costs have different IRS class lives. And generally anything that's less than 27 and a half years that you can identify is subject to this 100% bonus depreciation. So you can write off, generally 20 to 30% of a real estate purchase in the year you buy it with this 100% bonus. So this is one of the biggest things that our industry is really excited to see come through this bill. And this is going to lead to a lot of great tax savings for some people who are able to use this strategy correctly. Like I said before, opportunity zones are expanded and permanent. So quick highlight of what they were before, and it's generally still the same thing, is if you have capital gains, like any capital gains from Bitcoin, stocks, 1231 capital gains from real estate, you can roll this gain money over to a qualified opportunity zone fund, which invests in these census designated tracts that are low income. And the tax benefits for these are huge. The biggest one for me is like if you hold this for 10 years and then sell it, you pay no tax on the gain. It's the first time in the code where there's really a full elimination of the tax within opportunity zone, which I think is one of the coolest things I've seen come through in my career as a CPA. When you invest this capital gain money, in the original program, you get a deferral till 2026 and potentially a step up in your basis. So you'll pay tax later and pay less tax. A lot of this was expanded upon with the extension where they're going to designate new tracks that go live in 2027. And for the capital gains, like you sell stocks, put it in an OZ fund. If you do that after 2027, you'll defer that gain for 5 years and get at least a 10% step up in basis. Now, what's really cool for us up here in Idaho, where we're a very rural area, I have a client who lives in Moscow, and they have a 27,000 population and a lot of opportunity zones. So their step up in basis for their reduction on capital gain sales for investing in the op zone can go up to 30%. So I'm really excited about this new permanent implementation of the opportunity zones. And one more thing is that the governors and states will be selecting these opportunity zone census designated tracks every 10 years. And so we'll get a new map, so to speak, every 10 years of where these opportunity zones will be, which is great because the idea is like the money's supposed to go in, help a market, move it from this lower income to a higher income. And so these should be rolling as, opportunity zones help these areas in theory. A quick few other additional business tax changes is the excess business loss limitation is getting reworked a little bit where it doesn't include depreciation. So that was a big thing for real estate funds and syndications where we would often have to move that real estate depreciation life from 27 and a half to 30 years to be able to conform with the interest income limitation. Sorry, that was point 4 here. The first point, the excess business loss limitation, is staying in. So that what that basically means is if you're a single person and you have like $1 million of depreciation, you can only use 315,000 of it against your other income because the more excess of that 300K, so to speak, is excess and it gets carried over to the next year. So when you're planning your taxes, and you think you're going to get all this depreciation coming through, really look into the weeds here of it to see if you have other business income that can offset it, or if you're trying to offset W-2 income, you might find or capital gain income, you might find yourself in a place where you're getting limited by this excess business loss limitation. And that's not new, that's been around. QSBS, qualified small business stock, it got a few improvements. They started to do a step ladder where the gain exclusion starts to kick in at 3 years. And high level, what the QSBS stock is, this is for your C Corps. You could also be a prior entity that changes to a C Corp. And for people that hold that C Corp stock for 5 years, so long as it's small and there's revenue and asset caps on this too, you pay no tax on the gain on that stock. So they expanded this program a little bit, made it start to have a 50% exclusion for 3 years, 75% for 4 years, and just kind of increase the amount of times or money you can do through this program. And then lastly, Section 179 expensing. This is similar to bonus depreciation, but not 100% the same. So with Section 179, you're able to write off assets up to the amount of your income. So, and it's limited to $4 million now in total. That's different than bonus, where bonus, you don't have the income limitation, because in real estate, everything gets depreciated. There's no business income there often in the first few years. So you can't often use Section 179 in real estate. But this is just generally another good policy change for people to be incentivized to spend more and grow their businesses. If they're not in an industry that, buys real estate, or they want to do a combination of this 179 with bonus depreciation. So that was kind of a highlights of all the business tax changes. Now, there was a lot of individual tax changes as well too. And while this is kind of more passive investor focused, these things, there's still a few things in there we maybe want to hit on. So the first one that was really highly discussed was this state and local tax, or SALT, deduction. So previously under the last bill, on your itemized deductions, you're only able to write off $10,000 of your state taxes. So high tax states like New Jersey, California, Illinois, Connecticut, they all were paying a little bit more tax than other people. They've now raised the cap to $40,000, and it starts to phase down once you make over 500K. what is most interesting to investors for this is that a lot of the states over the past, 6, 7 years since the last tax bill got passed, started to do some workarounds to get around this SALT cap deduction limit. And what they started to do was implement like these PTET programs, or pass-through entity tax programs, at the state level. And so that means for S corps and partnerships, the business will now, or can now, and has been able to pay your state tax on your behalf. Very similar to a withholding, but with withholding, it's given to you as a credit that you take on your own tax return and still counts as your own tax payment. With these PTET programs, they're now business tax payments, and they send you a credit versus just the withholding tax. It's very nuanced, and it sounds like the same thing, but it's not, because now deduction gets taken at the pass-through entity level. So those state tax write-offs that the business did now get passed through to you on your K1 via line 1 ordinary, line 2 rental income. So this last BBB bill preserved these PTET regimes. And so that's great for investors and great for small business owners who own their own company and are able to actually pay their taxes through these businesses rather than getting it limited versus as a withholding or estimated or other tax payment to the state on that they make themselves. So that's the interesting thing about this. Just very high level, they codified the increase in standard deduction enhancements. They'll go up for inflation every year. This is interesting for investors with high net worth and a lot of assets out there, is that they permanently increased the estate tax exemption. And so high level, what this means is if you die, you owe 40% taxes to the government on your estate. Well, with this $15 million exclusion, that's $30 million for a couple, you get your first 30 million passed on to your heirs tax-free. So anything over 30 million is taxed at 40% if you haven't done advanced structuring, like I coach a lot of my clients to do. This was really cool to see. There's no sunset or expiration date here. This brings a lot of certainty back to tax planning, because the general thought was over the past 3, 4, 5 years, we had these draft bills that Biden might have done, or the increased exclusion is set to sunset at a certain time. So a lot of attorneys had these, draft documents ready to go for all their clients and saying like, hey, if these passes, sign this and move assets out of your estate into a dynasty trust, for example. But this gives us a lot more certainty to be able to plan and help for our clients and for your investors out there that are in the very high net worth world. You can plan a little more proactively and get some more exemption and pay Uncle Sam less when you pass on your wealth to your heirs. Very briefly, there was some child tax credit enhancements. They made them partially refundable. They increased them by about 10%. You've heard a lot about this, of these Trump savings accounts. They're similar to other plans out there, but still different. Basically, the story of them is like, for the next 3 years, anytime a child is born, the parents can apply. They get $1,000 from the government put into an account. And once that kid turns 18, they can start to take money out for approved purchases like school. At 25, they can take things out for small business loans. And at age 30, they get access to that $1,000 and whatever it's grown to at this time. When they take the money out, it's taxable income at that point in time. So other people still might like 529 plans or traditional, Roth IRAs for their kid if they start working in their teens. But this is an interesting thing to see out there. Another big thing I was talking about is overtime income tax relief. So basically what this means is you can get a deduction on your tax return for working overtime. So like, let's say you get $100,000 on a W-2, but 25K of that was for overtime and you're married. Well, now you're only paying tax on 75K. So, this will keep more money in people's pockets. And the theme of this, as you'll see throughout, is this is really incentivizing work. The entitlement cuts for like SNAP and Medicaid just brought in a work requirement. Like, hey, if you're able-bodied, work a part-time job, work 20 hours a week to get your SNAP and your Medicare benefits. And so that was a big theme throughout the bill, as you'll see this with the overtime and with the no tax on tips. I grew up in Las Vegas, and so Nevada was really excited about this no tax on tips promise from the campaign that we actually got out through this tax bill. So this is very similar to the no tax on overtime, where you can get $25,000 deductions. Like say you get $100,000 reported to you on 1099s or W-2s or whatever, but have 25K of tips, then boom, you're only paying tax on 75K. And so from an investor's mindset, this one and the last one put more disposable income back into the economy's hands. So they can go out to a restaurant more often, or they can buy an extra thing for their home, or they can, pay a little bit more for rent. So generally, these are putting more money back into people's hands, which is overall good for investors, I think, who cater to these types of customers. Um, One last thing in Idaho that we really like is that they got rid of tax stamps. So anytime you buy a suppressor or silencer, as they call them in Hollywood, you had to pay $200, and they got rid of that. So that was just kind of another small thing I wanted to add in up here. So kind of overall, what we're looking at from all these bills is, like I said, this is really hey, get back to work, guys. Okay, we all took, a lot of people took COVID off. Maybe you got, too drunk on these entitlement plans, but we got to get back to work as a country. Like people can be productive 20 hours a week to get your entitlements. They're incentivizing business investment between the opportunity zones, between the bonus depreciation, by just kind of streamlining some of the last tax jobs and cuts act stuff. Estate planning got a lot simpler for most people. Um, and you can optimize your tax strategy a little bit more now that we know what's actually going on, instead of like, well, this bill says that, the Senate bill says that, what's actually going to happen. We actually know now. And then energy sector shifts. You know, like I believe we should have a clean environment, but also, fossil fuels are a great way to, provide energy and lower costs for people. So that's kind of most of my slides here. Whitney, did you kind of want to ask me a few questions here and bounce around, and we can maybe open it up to the guests as well too?
Yeah, well, I first, I had several people ask, is this being recorded? Of course it's being recorded. I'll just double check. Yes, I hit record. So yes, that will be posted on our YouTube page, and you also get the recording afterwards. Um, as far as bonus depreciation, we had a question come in. Can you get 100% bonus depreciation if you buy a residential condo, which is built in 2020, or is it only if it's a new building that's put into use after January 19th, 2025?
So interesting question there. So if you actually have owned, it doesn't matter when it was built, it matters kind of when you bought it. So on that 2020 purchase, for example, if you've owned it since 2020, and you haven't done a cost segregation since then, it was 100% bonus back in 2020. So you could actually go in through your current, 2025 or 2024 tax year and get that cost seg done and run it through 2024 and 2025. So you've had that option for, the past 4 or 5 years if you've owned it since 2020. If you buy it and place it in service after January 19th, 2025, then, you just do the bonus in this year. So that's kind of the answer to that question. I hope that helps solve it.
Mhm. And so I want to, while we're waiting for more questions to come in from the audience, I wanted to pivot a little bit. If somebody's listening to this presentation, what are the first steps they should take in, trying to incorporate some of these changes into their tax planning, or questions they should ask their current CPA?
I think the first thing obviously is like, hey, how does this bill affect me in my tax situation? Um, is there anything we should do before year end to take advantage of this? What we do with a lot of our clients is kind of coach them through that whole cost segregation, buying a property, that whole process. We do a lot of advice on people who want to do short-term rentals, because short-term rentals, you know, kind of don't get stuck in this real estate professional trap where you can actually, take a lot of those deductions when you have your short-term rental and you're running it yourself. So just kind of ask your CPA, what this bill means for you.
Okay. Um, in where do you see investments, especially in the passive investing world, heading towards after the passing of this bill?
I think there's going to be a lot of advertisement around this 100% bonus depreciation idea. And for passive investors, you really need to sit with your CPA and see, does this actually help me? Because really, in order to get these depreciation benefits from a syndication or a fund, you need to be qualified as a real estate. You or your spouse, asterisk, need to qualify as a real estate professional in order to have these real estate, depreciation losses maybe offset your high W-2 doctor job, for example. So make sure you're actually getting what you expect when you put your money into something like a real estate fund.
Awesome. Now, I hashtag asking for a friend. When you went back to the Trump savings accounts, does that is there a mechanism in place for people who already have kids, or is this just for kids born, at the January 19th, 2025 moving forward?
Yeah, it's for the next 3 years.
So if you already have a child, can they?
You missed out. You have another one.
Yeah, no, I don't know if that's worth it. Especially when you figure out, I mean, if you want to, right? If that's in your plan, totally, totally do it. Uh,
Yeah.
okay, a follow-up question is, so if I decide to buy a building this month, July 2025, that was put in service in 2024 by the seller, I can get 100% bonus depreciation as the buyer now.
Yeah, that is correct. So it really looks to like when you place it in services, you're the taxpayer and you're the buyer. It doesn't matter when it's built, it matters when you buy it and place it in service.
So what does that look like? I mean, we've done several, presentations here on the Masterclass helping people understand what does that look like whenever they invest in, say, like a multifamily deal or an express car wash deal. Could you recap that for us? Like, how does that bonus depreciation work whenever somebody's investing in a passive deal through, say, a syndicator or an operator?
Okay, so let's say you invest 100K in a deal. And like I said, generally, you're going to get about 30% of a write-off in year one with this bonus depreciation. So if you put $100,000 into, say, a multifamily syndication, you'll on that year one K1 get a negative $30,000 rental income, plus or minus um, income from operations, but the depreciation coming through will be about $30,000. And they're generally, negative in that first year. So then you can take that loss, and if you're an active real estate professional, you can make a grouping election and have that $30,000 offset all your other income. If you're not and you're a passive investor living in passive land, this $30,000 loss can offset, $30,000 of other passive income. So if you're in funds that generate passive income, that are, ordinary businesses, some lending funds are actually set up as businesses. They don't that report ordinary passive income to their investors versus interest income. So you can kind of pair and put together a portfolio where you have some passive income over here that's positive taxable income, um, and then offset it with the passive depreciation from your real estate investment. So looking at your whole portfolio, um, you want to kind of plan around taxes and have some write-offs from this one that offset the income from that one.
Another question came in. Can you talk about the opportunity zone changes in the new bill? If I sell a business and have capital gains, how does it work to save on taxes?
Cool. Great question, Robbie. So let's kind of say this happens in 2027 because that's when kind of the new bill change things happen. And I don't want to talk about the old regime that's going to last another year and a half versus what happens in 2027. So let's say you sell your business for $100 million, right? You can in January 2027. So you have 6 months from the time of sale to invest the $100 million into an opportunity zone fund. And this is the $100,000 profit. So if you had like, um, 50,000 or 50 million basis and you got 150K or 150 million out of the whole thing, you only have to invest the gain portion. So it's a little different than the 1031 exchanges. So in January 2027, sell your business $100 million, and you put it into an opportunity zone fund within 6 months, and it goes and invests in opportunities on businesses and real estate across the country. So first things first is that gain on the $100,000 is deferred for for 5 years. So you won't pay taxes on that $100,000 capital gain or $100 million capital gain until sorry, until I think 2032, if I'm doing the math right in my head. So first you get a deferral. That's, time value of money in your pocket right there. You're not paying, 23% taxes on $100 million. You're saving 20, you're getting the use of $23 million for 5 years without paying taxes on it. Second is in year five, when that tax comes due, you'll get a 10% step up in your basis on that sale. So if I said you had, 50 million into it, that basis gets stepped up to 55 million. So now in year five, you're only paying tax on $95 million. And if you invested in a rural opportunity zone fund, you would get a 30% step up in basis. So 50 goes to 65. And then your new gain you're paying tax on is 85 million. So it's a gain reduction and deferral on your capital gains that you invest into an opportunity zone fund. And then if you hold this opportunity zone fund for over 10 years, the gain on any sale of that opportunity zone fund is tax-free. And how that works is, I said, the basis becomes the sales price. And so that also removes a lot of depreciation recapture too that would happen. So it's one of the coolest things I've seen out there, is one of the few ways to actually eliminate the tax. And I hope this nuanced thing answers your question.
So just well, Ravi asked, so I can't take advantage of that if I sell my business in 2025.
So if you sell your business in 2025, same thing, you have 6 months to invest in an opportunity zone, and your gain gets deferred till 2026. Because you're still operating under the TJCA rules of opportunity zones, where, gains got, it's because it was a temporary program, gains only got deferred till the end of the program in 2026. So if you sell your business today in 2025, you have 6 months to identify an opportunity zone to invest in. Let's say you invest in that opportunity zone, and then you don't pay taxes on the gain on sale of your business in 2025. You pay the taxes on the gain on sale of your business in 2026, and you don't get any step up in basis. But still, same thing. If you hold this opportunity zone fund and its assets for 10 years, then that gain becomes tax free as well too.
Switching a little bit, are there any changes to the intangible drilling cost deduction, and are they subject to the same limitations as bonus depreciation?
In my research, I didn't see anything explicitly on that, but I don't want to say definitively. This thing got passed about 4 days ago, so bear with me. I will say one thing about intangible drilling costs: when you invest in oil and the right working interest in oil and gas investments, those things don't get limited by this, passive real estate professional world. Oil and gas, the right oil and gas investments can offset, active W-2 or doctor practice income as well. So that's something a lot of passive investors like as well. I'm just really hyper focused on real estate myself.
Hmm. What is the biggest mistake that you see passive investors make during times like this when the tax laws are changing?
Some mistakes I see is, one, they might have heard something, either at a cocktail hour or on the news that was part of the draft bill, and think that might actually be reality now. So figuring out what actually passed is important. And then also actually really talking to a tax professional about what it all means, instead of just listening to YouTube or TikTok or country club talk about what, the actual tax thing is. People can talk a big game around the country club table. Oh yeah, I pay no taxes, blah blah blah. I did this, I did that, and then they go to their CPA, and I'm like, okay, that's not how it works. Maybe that person has a bad CPA, is embellishing, is doing something wrong. So be careful with where and how you get your advice.
Hmm. Well, James, we don't have any further questions coming in right now. If people want to get a hold of you, I know we are seeing it on the screen here, but for those listening in at a future date on the podcast, how can people do so?
Uh, Thanks, Whitney. So my website is stonehand.com. That's stone like a rock, Han like Han Solo.com. My LinkedIn is James Bohan CPA MRED. I'm most active on LinkedIn. I'm also on Instagram at James Bohan CFO. And my email is jb as in boy at stonehand.com.
Awesome. Well, James, thank you for being with us today. I know we have a couple more questions. You guys don't go anywhere, but wanted to wrap up with those people who needed to pivot right now. But again, thank you so much for sharing your time, knowledge, and expertise with us. And guys, reach out to James if you have questions.
Cool. Thanks, Whitney.